guys, and welcome to week 3. Let me check if I am on mute. No. Okay, how are you guys?
Doing well, thanks. Yourself?
Good, good, good. Good to see you, James. So let me start with week 3. So in week 3, we are going to introduce the microstructure, if you like, of the foreign exchange market. So if you have looked at the lecture slides for week 3, it's going to be part 1 of the market for foreign exchange. And in part 1, we are focusing on the spot market. Okay. So when we talk about financial markets and we talk about the spot markets, it means we are talking about financial assets that are traded and that are delivered or settled in the current time, right? So we're talking about transactions that happen in real time. Whereas if we talk about the derivatives market, for example, like the forward market or futures market, so these are for financial assets that are settled in a future time, okay? So in part 1 of this topic, we are looking at the spot market. And in part 2, we'll be talking about the forward market, okay? So the relevant chapter for this week and also week 4 is chapter 5. Where we talk about the foreign exchange market. Okay.
So, Professor,
Yes.
do both the parts include the extension of the same topic?
What do you mean? Sorry, I don't get the question.
Does even part 2 have the same foreign exchange market, or how is it?
So we will be talking about the foreign exchange market as well, but in part 2, we are talking about the forward exchange market. Okay.
Okay.
Yeah, so we look at just the forward contracts for foreign exchange. All right, so before we move on, is there any other questions from your readings or from your homework or from the quiz? Any questions at all?
I have a couple questions with the tutorial questions, but we can get to that later on.
Yeah, sure. Yeah, definitely. So if you do have questions for the tutorial, let's hold on. So this is the agenda for the workshop today. So in the first 2 hours, I'm going to try to go through the theory part of the chapter. So we'll first look at the main points of the topic, and then we'll look at the theory questions for the tutorial. And then in the second part, we will try to solve the numerical problems, okay? So realistically, I don't think we can go through all the questions today. But I really do want you to understand the, number 1, the quotation of the exchange rate market. And number 2, understand the bid and ask spread, okay? So these are the important points that will set the scene for the rest of the semester, okay? Okay, so now in the first part of the chapter, we introduce the structure of the foreign exchange market. So one of the main sections that we talk about was how banks record international transactions, right, between themselves. So we talk about the network of correspondent banking, where they hold demand deposits with each other, and they how do I say? And they transfer currencies through that correspondent banking relationship. Okay, so this will be your question 4 later on. Now we also look at how banks code their currencies, so how they put up a buy, a bid price, and a sell, an ask price, right, in the dealer foreign exchange market. Okay. We also introduced a few quotation terminologies. So we talk about the direct versus indirect method. So when we talk about the direct quotation method, this is when we quote the foreign currency in the domestic currency, right? So for example, So we are in Australia, so our home currency is the AUD, okay? Now let's say we want to look at the relationship between the AUD and the pounds. So for our, from our perspective, the direct quotation would be the price of the pounds in the AUD, okay? So here I'm gonna say AUD per pound, okay? So this exchange rate tell me how much AUD each pound is worth, okay? So this is the price of the pound in the AUD. In contrast, when we look at the indirect quotation, this is when we price the home currency in the foreign currency, okay? So in this example, it will be the value of the AUD in the pound, okay?
Professor, could you just repeat what you said?
Okay, sure. So with a direct quotation, we are trying to price the foreign currency in the home currency, right? So if I am an Australian citizen and I'm looking at the value of the Australian dollars versus the pounds, then this will be my direct quote, okay? So here I'm trying to price the pound in the AUD, okay? So this exchange rate tells me how much a pound is worth in the AUD. The indirect quotation, on the other hand, is the price of my home currency versus the foreign currency, okay? So here, this exchange rate here is an indirect quotation for an Australian citizen because this gives me the price of the AUD in the pound, okay?
Am I right to say that the denominator will always be the £1 or $1?
Exactly, yeah.
An easier way to look at it, and then
Yeah.
the top is the how much is that into the dollar or pound?
Exactly, yeah, spot on,
Okay.
James. So the denominator is always the £1 equals to how many whatever Australian dollars, okay? Similarly, here you can say that this is 1 AUD equals to how many pounds, okay? So that's a good point. So you will see throughout the course, there will be two ways that the currency exchange rate will be quoted. The first one is what I just did before, so AUD over pounds. And the second method is you can write £1 equals to how many Australian dollars, okay? We also introduced the American terms and the British, I think, the British terms. So in the American terms, it's in USD. So this is the American terms. So here you're pricing the other currency in terms of the AUD, okay? So this is called the American terms. In contrast, you have the per USD quotation. So in this case, you're pricing the USD in terms of the other currency, okay? So throughout the workshop, I'll point to you the relevant table, okay? Now, we also introduce how banks, how bank dealers, either banks or other non-bank institutions, how they put up their bid and ask quotes, okay? So when we see the word bid, we're talking about the buy price that the dealer is trading at. And when we look at the ask price, this is the price that the dealer is selling at, okay? I'll give you an example later on. All right, so with the foreign exchange rate market, this is a dealer market in the sense that the market is run by a network of dealers, okay, banks or other institutions. So what dealers do is that they stand there, they put up the prices and they stand there ready for people to trade against them, okay? So if you want to go buy currencies, you can go to the CBA tomorrow, I mean virtually now, and you trade with them, okay? So a bank will quote a two-price quote. They're going to have a bid rate and they're going to have an ask rate, okay? So the bid rate is the rate that the bank or the dealer is buying. So if I want to go and sell the USD, right? So say I have 1,000 USD, and if I want to sell, I'm going to the bank and I'm going to be selling to the bank at their bid rate, okay? So as a client, I will always be transacting at the opposite rate. Whereas for the bank, they will be trading at their rate, okay? So if I'm a client and I want to sell the USD, I'm going to be selling at the bank's bid rate, okay? In contrast, if I want to buy a currency, I'll be buying at the bank's ask rate, okay? So essentially, the customers or the clients will be paying the bid and ask spread, and the banks will be earning the bid and ask spread, okay, for their market making fees. We'll talk about that later on. I have an example for you guys. Okay, so this is what we talked about before, okay, in terms of currency quotation. So this is from a financial press. And what they have here is they've got a table of currency quotations, okay? So for this week, you don't have to worry about the forward rate yet. So just focus on the spot rate for now. So the first rate in the currency quotation is your spot rate. And here I'm looking at the euro, okay? So I'm looking at the value of the euro. And in the table, I've got the value of the euro against the USD, yeah? So in the second column here, this is the value of the euro in the USD, okay? So this column tells me how much a euro is worth in terms of the USD, okay? So this is 1 euro equals to how much USD. In the third column, this is the per USD values. So this column tells me how much 1 USD is worth in the respective currency, okay? So if I look at the euro, then this number tells me how much a USD is worth in the euro. So 1 USD is equal to 0.8833 euro, okay? So this is going to be important later on, especially in your assessments, okay? So for example, I can give you like a table like this, and you need to work out a certain number based on this table, okay? A side note is that the textbook that we are using is an American textbook, and so you will see that the authors refer to the US as their home country. Okay, so as a result, the implicit assumption throughout the textbook is that the USD is your home currency. Okay, but of course in the exam I'll tell you a bit clearer, I'll give you a bit more context. Okay.
I'm really sorry, Professor, but
That's all right.
Could you just explain the per US dollar again?
This one here?
Yes, the per US dollar part. The one which you just explained, the 1 USD is called 0.8833 euros.
Okay, sure. So that will be my, so by the way, if we are an American citizen, then the direct quote is this one here, the second column, and the indirect quote would be the third column, okay? So I'm gonna explain this point again. Let me erase these first. So here, if I look at this column here, this number tells me the value of 1 USD in terms of the relevant currency. Okay, so in this case, I'm looking at the euro. So this 0.8833 number is how much 1 USD is worth in the euro. Okay, so if I go to the bank tomorrow and I want to exchange 1 USD to euro, then I will get 8833 euro. Okay, is that clear, Anupam?
Yes, Professor.
Thank you. Okay. So you will also notice that if we take the reciprocal of one number, you will get the other number. Okay. So for example, if I take 1 divided by 1.1321, so this is my this is how much a euro is worth in the USD. Now I will get 0.8833. Okay. So the value of one currency is the reciprocal of the value of the other currency. Okay. So what that means is that now when you have a currency exchange, say if I exchange the euro and the USD, now in the currency exchange, you would always have two opposite cash flows. So for example, if I say I want to buy the euro, right? So here I want to acquire the euro. So if I want to buy the euro by exchanging the USD, then I'm going to have to give the bank the USD. So I'm going to have a cash outflow in the USD. And in exchange, the bank gives me the euro, right? So here I'm going to have a cash outflow in the USD. And I'm going to have a cash inflow in the euro, okay? So if I buy the euro, I will be paying the USD to the bank. So that will be a cash outflow in the USD. And then the bank gives me the euro. So that will be a cash inflow in the euro. Okay. So as a result, if I say I buy the euro, it's equivalent to saying I sell the USD, right? Because the cash flows are exactly the same. Okay. Okay. The second important thing for this chapter and going forward is also currency quotation. So normally, if you want to denote a currency exchange rate formally, it could be denoted as SJK, right? So S stands for the spot rate as opposed to the forward rate, which we'll look at next week. J is the measurement currency, and K is the commodity currency, right? So when we say commodity currency, we're talking about the currency that is priced, okay? And the measurement currency is the price of that other currency, okay? So another way to understand currency exchange rate is you can say that this exchange rate here, J over K, is the price of currency K, the commodity currency, in currency J, the measurement currency, right? So for example, if I give you this exchange rate here, so if the euro over USD is 0.8657, can someone tell me what this number means? So what does this number tell me?
1 USD equals that number.
Exactly, spot on. So 1 USD is equal to 0.8657 euro, right? Oopsie. So euro. All right, second question. So if I want to find how much 1 euro is worth in the USD, how do I do that? So here I've got the value 1 USD. But
You
what
do
I
the
want,
reciprocal of it?
exactly right, spot on. So if I want to find the value of the euro in the USD, I'm going to take the reciprocal of 8657. Okay. And that will be 1 point something. Okay. Okay, so to make it even more complex, I'm going to introduce the bid and ask spread. Okay. So in terms of notation, when I want to denote like a bit rate, I can write SBJ over K. So SJ over K is exactly the same as before. And I'm just going to add B here for the bit rate. Okay. So if I want to denote an ask rate, I can say SAJ over K with A standing for ask. Okay. All right. So one more thing. So if I want to find so let's say if I have the J over K exchange rate, and if I want to find the K over J exchange rate instead, with the presence of the bid-ask spread, I can convert the exchange rates using this equation here. Okay. So when I take the reciprocal of a bid rate, I will get a an ask exchange rate, right? And vice versa. Okay. So this is something that you have to be careful about in terms of calculation. Okay. So if you take the reciprocal of an ask rate, you're going to have a bid rate and vice versa. Okay. All right, this is a bit hard to see, so I'm just going to write this down on a whiteboard. Let me share with you a whiteboard. Okay. So here, suppose, let me see if I can have it here. So let's say I go online and I observe these two rates from ANZ and Commonwealth, right? Oopsie, CBA. Now let's say I'm looking at the USD versus the AUD, and this is how much an AUD is worth in the USD. Okay. Let me make up a number. Okay. Let me make up another number too. So let's say 0.8975. Okay. Now, let's say I can observe that these two banks are giving me these quotes for the Australian and for the USD against Australian exchange rate. Now, if I am a client and I want to trade the AUD, if I want to buy, which rates would I be looking at?
Bank.
Sorry, can you say that again?
Commonwealth Bank.
If I want to buy, yes, I'll be buying from Commonwealth. And why is that the case?
Because the price for buying USD is less when compared to ANZ rates.
Yep, exactly right, spot on. So let me just use another color. So if I'm a client and if I want to buy from these banks, I'll be looking at their ask rate. Okay, so I'll be comparing their ask rates. Now, because I am a client, I trade at the opposite of the bank's rate. So whenever I want to buy, I look at the ask rate. Okay. So for a client, I want to be buying at a cheaper price. So comparing these two numbers, the CBA rate looks better for me because I can pay a lower price. Okay, so we buy from here, which is cheaper from the ANZ rate of 8,979. Okay. On the other hand, if I want to sell, where do I want to sell?
ANZ.
ANZ right, spot on. So I can sell at 1 pip higher in ANZ relative to the CBA. So here, okay. So when you have a question, it's very important to identify whether you are a client or you're a trader or you're the bank. Okay, so that you can determine which rates that is appropriate for you. Okay. All right, let me go back to my screen. Okay. So in terms of currency conversion, so let's say if we start with $10,000, right, and we want to convert that into pounds, right? So we are a trader in New York, and we want to take a position in the pound. Okay, that is equivalent to $10,000. Now, let's say we are faced with these quotes. Right, so we go to a bank and we see these quotes on the bank screen. Now, what do these numbers mean? So if we look at the first exchange rate, right, so if we look at the dollar over pound exchange rate, so these rates are telling me that if the bank is buying the pounds, they will be buying the pounds at 1.25 USD. And if they sell, they are selling at 1.2505. Okay. Conversely, if we are looking at the dollars, right? So if we look at the reciprocal exchange rate, so if the bank is selling, if the bank is buying the dollar, they will be buying at this rate. And if they sell, they'll be selling at 9. So this means 0.7980. Okay. Oopsie, sorry. So that would be 0.80. Sorry, that was wrong. Okay. So suppose that I want to take a $10,000 position in the pounds, and given these two codes, can someone tell me how much pounds would I get after the conversion? Okay. So here my principal is $10,000. And I want to convert it into the pounds. The question here is how much pounds do I get?
7,996.
And how do we get that number?
You simply divide that.
So you take this and you divide by what?
1.2500.
1.25. Yeah, that's right. That's right. Let me go here. Sorry. So yep, that's right. So if I have 10,000, now in this case, if I have 10,000 and I want to exchange into the pounds, I will have to determine what am I buying or selling, right? So if I go to the bank and I sell the USD to the bank, I'll be selling at their bid rate for the USD, okay? So the first method is you can look at the selling rate for the USD and you work out your equivalent pound. Alternatively, I can frame the question as I'm going to acquire the pound. Okay, so how much pound can I acquire with $10,000? So here I'll be buying the pounds. So in this case, I'll look at the appropriate rate for a client who wants to buy the pound. Okay, so I'll look at this first rate here. In the first method, I'll be looking at the second rate. Okay. So one easy way to remember which exchange rate to use to convert from one currency to the other is to use this equation here. Okay. So this equation tells me that if I start with the dollars and if I want to end up with the pound, then I need to multiply the dollar amount I have with the pound divided by dollar exchange rate. Okay. So this is how it works. These two will cancel each other out and I will be left with the pound on the right hand side. Okay. Does that make sense, guys? So I think this is very useful later on for more complex questions. Okay. So if it helps, then you can use this equation for your own practice. Okay.
Oh, ma'am, I'm so sorry. Could you just explain the formula just once
Yeah,
again?
sure. No problem. So here, this is how I'm going to convert from one currency to another, right? So I'm going to have a starting point, right? So this is the starting amount, right? Let's say in this question, I've got $10,000. Now, from the dollar, if I want to convert it into the pounds, then I'm going to multiply the dollar amount I have with this currency exchange rate over here. Okay, so this exchange rate is the pound over the USD. Okay, and why do I want to do that? That's because these two will cancel each other out so that I'm left with just the pounds. Okay.
Yeah, got it. Thank you so much.
So if you look at the calculation on the right hand side, it will be similar to the calculation that we did on the left hand side. The only difference here is that this is what I did, right? So here I'm taking the reciprocal of the dollar over pound exchange rate. Okay. So if you take the reciprocal of the dollar over pound exchange rate, you're going to end up with the pound over dollar exchange rate, okay, which is the same as before. Now, so we're 37. Okay. So I know it's confusing if it's the first time you deal with currency conversion, but after a while you get used to it, okay? Just be careful when you have bid and ask rates, okay? In which case you have to identify whether you use the bid or the ask, okay? All right. Sometimes you don't get a direct exchange rate quotation. So some currencies, let's say, normally currencies will be quoted against the USD because it's the most common currencies that are used in the world. So sometimes you don't get a direct exchange rate between two currencies that you want. So, but if you want to find out the exchange rate between these two currencies, nevertheless, you can use something we call a cross rate calculation. Okay. So a cross rate is an indirect rate that you infer from two other exchange rates. So in this case, you've got three currencies involved. So for example, in this case, let's say you go to the market and you see that the bank give you two quotes. So the bank is quoting the euro against the dollar, and it quotes the pound against the dollars. Okay. So this is what you observe in the market. Now, suppose you want to find out the exchange rate between the pound and the euro instead. You can actually work out this exchange rate by looking at the first two exchange rates. Okay. So by doing a cross rate calculation, you can work out the value of the euro versus the pound from these first two exchange rates. Okay. So how do we do that? Now, this is the exchange rate that we want. We want the exchange rate between the pound and the euro. Okay. So here I'm trying to work out the value of the euro in the pounds. So what I'm going to do is on the right hand side, I'm going to rewrite. I'm going to take into account the dollar into my equation. Okay. So here I'm going to rewrite this exchange rate as the product of the pound divided by the dollar times the dollar divided by the euro. Okay. So this one, the pound divided by the euro exchange rate is equivalent to the product of these two exchange rates. Okay. As you can see, these two will cancel out. So you'll be left with the pound divided by the euro. So from here, I'm going to substitute the numbers that I have from the question to work out the value of the pound over euro exchange rate. Okay. So in the question, I'm going to look for the pound over USD exchange rate. Okay. So the question gives me the dollar over pound exchange rate, which is 1.25. What I want is I want the reciprocal of that rate. Okay. So this exchange rate here is the reciprocal of what I have in the question. So here I'm going to write 1 divided by 1.25. Okay. The second exchange rate, dollar over euro, this is given directly in the question. Okay. So here I'm just going to times this by 1.05. Okay. So doing this calculation will help me work out the pound over euro exchange rate. Okay. Now, throughout the subject, you will also use the cross rate calculation quite a lot. Okay. So it's good to understand how to do it now. Any questions with this calculation at all?
Yeah, sorry, Mani, kind of explaining it once more with the reciprocal part. I got lost there.
Yeah, sure. Let me erase it first. Okay, here. Yeah. Okay, so are we okay with this part? Yep.
Yeah, I'm fine with that part. Yeah.
Okay, that's good. So next we need to replace the numbers into the formula, right? So the first number I need is the pound over dollar exchange rate. Are we okay with that?
Yep.
Yep. Now the question does not give me this exchange rate, right? The question gives me the dollar over pound exchange rate.
Yep.
So if I take the reciprocal of this, so this is my dollar over pound. If I take the reciprocal of that, what do I get? So if I take the reciprocal, then this one will become 1 divided by S times pound. Okay. So this will be your pound over dollar exchange rate. Does that make sense?
Yeah.
Yeah. Okay. So where were we? So in the question, we're given the dollar over pound exchange rate. And what we want is we want the pound over dollar exchange rate, right? So to find this number, you're gonna need to take the reciprocal of the number given in the question, okay? So from here, I want to take the reciprocal. And that will be the first part of my calculation. For the second part, as we mentioned before, it will be directly taken from the question, okay? So if I take 1.05 divided by 1.25, that would be my pound over euro exchange rate, okay? Where are we now? We are 45. All right. So to make the matter a bit more complex, I'm going to introduce the cross rate calculation. I'm going to introduce the bid-ask spread in the cross rate calculation. Okay. So from the previous slide, we have looked at how to calculate the cross rate from two different exchange rates. Okay. So we said that if we want to find the pound over euro exchange rate, we are going to take the pound divided by the USD times the USD divided by the euro. Okay. So if we want to denote it more formally, we can use this equation here. So if I want to find the J over K cross rate, I can write it as J over N times N over K, with N being the common currency. Okay. So in the previous example, J is my pound and K is my euro. N is my USD, okay? So when you introduce the bid and ask spread, it's going to be the same principle, but it's a little bit more complex, okay? So in this case, if I want to find, let's say, the bid rate, the bid cross rate, J over K, I'm going to start with the same formula. So I'm going to write J divided by N times N divided by K. Now, if I want to find the bid rate on the left-hand side, then on the right-hand side, I'm going to write bid for both of my other exchange rates. Okay, so this is very important. If you want to find a bid rate on your left-hand side, you need the bid rates on your right-hand side as well for these exchange rates, okay? So for example, now let's say I've got these two quotes from a bank, right? For the pound over dollar exchange rate and the euro over dollar exchange rate, okay? I've got the bid and I've got the ask prices for each of the exchange rates. What I want to find is I want to find the pound over euro bid and ask rates, okay? So I need the bid and the ask as well. So let's work through the calculation for the bid rate first, and then you guys can help me with the ask rate, okay? Let me start the whiteboard. Right, so let's write down the information that we have. So with the pound over US dollars exchange rate, my bid rate is 1.25, right? and my ask rate is 1.2505. Okay. Let me write it properly. With my euro versus dollars exchange rate, it's going to be 1.6587 and 1.6597. Okay. Now let's say we want to find the bit rate for the pound versus the euro exchange rate. Okay. Can someone tell me what my equation would be? What do I have on my right hand side? So I need two bit rates
Be
here.
pounds over euro.
So,
Pound by
Oh, no,
pound to dollar.
did someone say something?
Yeah,
Can you
pound
repeat?
over dollar.
So pound over dollars, yes. So I need my common currency here.
Yeah, and dollar over euro.
Dollar over euro. Yes, spot on.
Excuse me, you've written it wrongly. That's dollar over euro for the second one. Second code. No, in the second code.
The second code, this one.
Up. No, up.
This one here.
No, left. That's dollar over euro.
No, this is something I just made up. So let's just go for it for now. Let's say this is what you observe, right? So euro over dollar. Does that make sense?
These are both over dollar?
Yeah, let me go back to my slide. Yeah, so it's the euro over dollar. I just made this example up just to show you how to do the cross rate calculation. So it's not related to your lecture slides.
All right.
Let me go back to my whiteboard. All right, so it's spot on. We have got our formula right. Next step is to substitute the numbers into the formula, okay? So can someone tell me where I can find the first rate? So in this, yes?
That would be 1.25.
So I need the bit rate for the pound over dollar. Yes, so that will be
Yeah,
1.25. Spot on.
And the other side will be 1 over 1.6597.
So I need the bit rate for the dollar over euro. Okay, so you got the first part right. So I need to take the reciprocal of this exchange rate, right?
Yeah.
But
So
the
1 over the ask rate.
exactly right, spot on. Did you say ask?
Yeah, ask.
Yep. Sorry, I missed that part. That's right. So here, so the bit rate for the dollar over euro exchange rate is going to be the reciprocal of the ask rate of the euro over dollar exchange rate. Okay. Spot on. So I'm just going to write the numbers here. So 6597. Okay. So if I times these two numbers, I mean, if I take 1.25 divided by 1.6597, let's see what I get. Okay. If you do the calculation, can you tell me the answer as well?
I got 2.075, 746. But I'm not sure.
No, it shouldn't be
Oh.
2 something. So here you're gonna take 1.25 times 1 divided by 1.65.
0.7531.
0.7531.
Exactly, spot on. So here it's going to be 7531. Okay. Spot on, guys. Well done for this part. Now, can we do the second part, which is the ask rate? So what I need here is I need the ask rate for the pound over the dollar exchange rate. Okay. So after this exercise, I'll give you a short break of 5 minutes. So help me with this calculation, and then we can have a short break. Okay.
Sorry, I'm a bit confused. Where's the answer of 1.65 come from? Are those equations on the bottom the same, or?
Yeah, so which is so this number comes from this part here, James.
Oh, I see. Yeah. So it's not 1.25 times that equals that. That's just what SA
Oh, yeah.
equals.
Yeah,
Oh,
sorry.
okay.
Yeah,
I see.
yeah.
Yep. No
Yeah.
worries.
Sorry, I was taking a shortcut.
Yeah. All right. So for the ask.
Yeah.
So for the ask, should we just use the reciprocal for the bit rate? 1 over 0.7531.
Let me write down. So here you got the first part, which is here. Yeah, exactly. Yeah.
Is the asking I mean, like is the answer for this 1.3264 by any chance?
It shouldn't be that big. Let me do my calculation. So before we go that far, can you tell me what the numbers here are?
1.6587.
1.65874. So you take 1.6587.
Yeah, and multiply it by 1 by the asking rate.
No,
1.2505.
it doesn't look too right to me. No.
Can you please do it on the board? It's a bit confusing.
Yeah, okay. Can you guys help me? Now, what do I need on the formula? So here I'm going to need the ask rate for what? Pound over.
Hold on.
Oops.
Oh no, pound over
Okay.
euro. Sorry.
Yeah, sorry. This is my bad. Okay. So I'm going to do the pound over dollar times the ask rate for dollar over euro. Okay. So where do I get this? This will be here. Okay. So 2505. And where do I get this?
It's 1.65.
Yep. So I'm going to take the reciprocal of 1.6587. Okay. So it's similar to the exercise that we did before. The only thing is we changed the ask rates for our calculation. Okay.
So
Yep. Did someone
then it
say
is 0.7539.
0.7539?
39.
Yep. Let me check the calculation. 6578. Yep, exactly.
Aren't we taking the ask rate over here?
Which part?
The second part, where it is dollar by euro.
Dollar by euro. Yes.
Yeah.
So here, go on.
So the ask rate is 97, right?
This is the ask rate for the euro over dollar. But what we
okay.
Yeah. So what we want is
got it.
yeah, exactly.
Hi, sorry, I just have a question.
Yeah, sure.
So the first problem, shouldn't it be 1.6597 the first time, and the second time 1.6587 the second time it should be 1.6597?
No, so the first one is we need the ask rate for the euro over dollar exchange rate. Remember when we take the reciprocal of an ask rate, we will have a bit rate of the opposite currency. So let me write it down clearer for you. So here I need the bit rate for the dollar over euro, and it will be the reciprocal of the ask rate of the euro over dollar. Does that make sense? That's why we use the ask rate here in the first calculation.
Okay.
Yeah.
Okay.
Yeah, so just be careful, guys. When you have the bid and ask spread, when you take the reciprocal of an ask, you're gonna get the bid rate of the other exchange rate. Okay.
Why that's the case is a bit confusing.
That's because here you're looking at the rate that you buy the euro, right? So here you're saying that buying a euro is equivalent to selling the dollar. Does that make sense? So when you have an exchange rate conversion, when you buy one currency, is equivalent to selling the other currency.
Yeah. Thank you. Yes.
Yeah.
Yeah, I see.
So good question. That's something you have to be careful about. Okay. All right. Any more question about this calculation?
So all good.
Okay, that's good then. So let's take a short break of 5 minutes, and when we come back, we will talk about the other part of the theory questions. Okay.
Okay.
Are we ready to come back?
Yeah.
Okay. Thank you. So to make things even more complex, I'm going to introduce currency arbitrage. Now, the reason why this is a popular topic in foreign exchange is because a large chunk of foreign exchange trading is arbitrage trading. Okay, so we need to understand what arbitrage is and what is the basic idea of an arbitrage strategy. Okay. So when we talk about arbitrage, we are talking about a strategy that is trying to make profit based on mispricing. Okay, so mispricing is when we have one identical asset and we trade at two different prices in two different marketplaces. Okay, so for example, suppose for some reason an iPhone is priced at $1,000 in Australia, but people in Vietnam are willing to pay 1,500 for a Samsung phone. Okay, so the same identical phone manufactured by the same company, but is priced at two different prices, right, in two different places. Okay, so this is when we say there's a mispricing. Okay, that means the same product is priced in two different markets differently. So as a smart trader, now if you want to make profit in this case, what would you do?
I will buy from Australia and sell it in Vietnam.
Exactly right. So I'm going to buy here and I'm going to sell here. Okay, so I'm going to be buying the same identical product in Australia, go to Vietnam and sell it for a higher price. Okay, so I'm going to buy at 1,000 and I'm going to sell at 1,500. Okay, so how much do I earn?
$500.
$500, right, spot on. So I earn the spread between the different prices. Okay, so to generalize, an arbitrage strategy or a strategy that is based on mispricing generally involves two transactions on the same identical asset, right? So on the one hand, you're going to be buying an asset at a lower price. And then on the other hand, you're going to be selling that same identical asset that you just acquired at a higher price somewhere else. Okay, so your arbitrage profit will come from the difference in the prices. Okay, So there is a key distinction between an arbitrage strategy and a normal, say, a normal investment, right? So let's say if I want to invest in a stock, I hold it for a few years, and later on it appreciates in its price, so I earn a capital gain, right? So the main difference between an arbitrage strategy and a normal investment is that with an arbitrage strategy, at the start, when I set up my strategy, there is zero cost involved. Okay, so what does that mean? If we look at this example, this simple example before, now this is a zero cost strategy because suppose I don't have $1,000 to trade, right? So what I can do is that I can go to Vietnam and say to someone that I'm going to sell you a phone for 1,500, right? And I'm going to get that money first. Then I'll go to Australia, use that 1,500 to buy the phone, pay $1,000. Okay, so in this case, with an arbitrage strategy, you do not have to have an initial investment to earn profit. So your transaction at time zero should self-finance in the sense that you will not be out pocket anything. Okay. Yes.
I have a simple doubt. Like, where did we got this 1,500 from when we don't have 1,000?
So suppose I can go to Vietnam and sell to someone, get the money first, and deliver the phone later, right? So
yeah, how are we selling it now? Like, we don't have money to buy a phone in Vietnam too. So how are you gonna buy the phone there?
I'm not gonna buy a phone in Vietnam. I'm gonna sell to a Vietnamese consumer first, and I get the money first, and I promise to give them the phone tomorrow, for example. So, and then I'm gonna use that 1,500 I get from that buyer.
Okay, yeah. Got it.
Yeah. Sorry, it's a bit unrealistic, but so in financial assets, it's easier to do. You can short sell, right? So with financial assets, you can short sell. You sell first, and you deliver the financial asset later on.
Excuse me, I got a question.
Yes,
Is
James.
arbitrage only if it has zero risk, or does it have to be immediate as well?
What do you mean by immediate?
Usually, like in an exchange rate, you see two different prices, and you can make the quick, buck immediately. But can it still be arbitrage if you have to wait, let's say, a week, but there's still zero risk involved?
Good question. So normally an arbitrage opportunity does not last too long. So typically it tends to be a short-term strategy.
Okay.
Yeah. So normally we're talking about day trading. Yeah. Good question. Yeah, good question. Yeah, so typically short-term, but maybe it could be up to 1 week or so. Okay. The second point is it has to be zero risk. So in this example, for example, you don't bear any risk here because your two positions in two markets perfectly offset each other, right? So in one market, you acquire a phone, right? So you buy the phone in Australia, but immediately you're going to be selling that same phone to someone in the other market, okay? So that you don't get exposed to any underlying asset, okay? So typically in an arbitrage strategy, you will have two or more transactions that perfectly offset each other, okay? All right. So that is the main part for the first part of chapter 5 when we talk about the spot foreign exchange market. Okay. So the key takeaway is I really want you to understand how currencies are quoted and also how to convert currencies, right? Like we did before with the bid and ask spread, so on and so forth. So in terms of our tutorial questions, we've got a few theory questions and I can group them into two So from questions 2 to 6, they are contextual questions. So they give you a bit more information about the foreign exchange market. In question 8, it tests your understanding of currency quotation strategies. Okay. So do we want to go through all the questions one by one, or are we happy to pick important questions to go through in class? And you can read the rest at home.
I had problems with question 3, problem 3, sorry, problem 3 and problem 8. So if we could do those two at least, I'd be happy.
Okay, so problems 3 and 8, did you say?
Yeah, problems 3 and problem 8.
Okay, sure. Any other ideas, guys?
Go through the like really tricky ones, because like we've learned a couple of concepts right now with involves everything. So maybe if you could work out something, I mean similar questions, it would be quite helpful. I mean to
Okay.
understand further.
Okay, so you prefer to pick the tricky ones.
Yeah, I mean start with one basic and probably just a gist of like the rest of the questions just for a better understanding, because we learned like too many concepts like in a day. So
yeah.
yeah.
Okay, so let's so I'll pick a few questions that I think we can go through in 45 minutes, and that will involve some of the tricky questions, and definitely problems 3 and 8.
Sorry, I actually misspoke. It's problem 1, not 3. I understand
okay.
3 a little bit, so problem 1 would be great. Thanks.
Okay, thanks, James. Okay, let me go through problem 1. Okay, so for the time being, then I'll skip questions 2 to 6 because I think you can read those at home. I'll talk briefly about question 8 because if you understand question 8, you'll find the rest of the topic quite easy. So let's go through question 8 then. Here we go. Question 8. Okay, so let's look at this question. So basically, this question tests our understanding of the bid and ask prices, okay, and what banks are expecting when they put up their bid and ask quotes. So in this question, we've got an exchange rate. We have a currency pair between the Canadian dollar, so CD, and the US dollars, okay. So when we say the small figure, we're talking about the last 2 digits, right, in the currency quote. So this bank is currently quoting 35.40, and the rest of the market is 36.41. Okay. So the question is, what is implied about the trader's beliefs by his prices? Okay. So here I've got. This is the bank that I am interested in. Let's say Bank A. They give us a quote of 35.40 for the currency, for the exchange rate between the Canadian dollar and the US dollar. And the rest of the market is giving me a quote of 36.41. Okay. So the question is, what does it tell us about the bank's belief by their prices? Okay. So before we answer the question, I just want to emphasize that these quotes are the prices of the dollar in the Canadian dollar. Okay. So if I rephrase this question, it's asking us what is the bank's expectation about the value of the USD in the future. Okay. So where does the bank think the USD will go? By putting up this quote. Okay.
It thinks it depreciate.
Which currency?
Canadian dollar.
Why is that the case?
So bank is quoting a lower price, which is 1.3435. I think that's a lower price, so it means they're expecting for Canadian dollars to depreciate.
So these are the prices for the USD. Okay. So you were right in the first part, but you mixed up the currency, I think.
Dollars.
Yeah.
I'm
So
making
here,
dollar to depreciate.
so the bank is thinking that the USD is going to depreciate against the Canadian dollar. And so that's why they lowered the prices for their USD. Okay.
Sorry, why do they lower the prices if they think it's going to appreciate?
So when they lower the price like this, do you think they are trying to attract buyers or sellers of the USD?
Yeah, I guess because right now they can attract more buyers. If there is more depreciation, they'll be interested.
Can you repeat your answer, please? I can't hear too well.
Now you can hear me?
Yeah.
Yeah. I think, according to my perception, is that if they attract more buyers right now, they could be in profit if USD depreciates.
Yeah, exactly. So they're trying to attract more buyers, right? Because they're trying to sell. So their sale price here is a bit more attractive relative to the market. So what they're trying to do is therefore they're trying to dump the USD inventory, right? So you only dump something if you think the value is going to decrease.
And because the USD would decrease, the Canadian would increase?
Yeah, so the USD is expected to decrease relative to the Canadian dollars. Yeah. So when we talk about currency values, it's relative. So one currency goes down, the other goes up, relatively. Okay. Okay, so let me skip question 9 for now. We can go straight to problem 1, okay? So in problem 1, we're given the exchange quotations for a few currencies, and we are asked to compute the cross rates for the following currencies, right? So here with the cross rate matrix, basically we're asked to compute something like this. So I've got 4 currencies. I've got the euro, the Swiss franc, the yen, and the pound. And I want to compute the cross rate between these currencies, okay? So essentially, I try to find out the cross rate between, let's say, so these values will be 1. So I'm trying to find out the cross rate between the franc and the euro, the yen and the euro, the pound and the euro, the franc and the yen, the franc and the pound, and finally the pound and the yen, okay? So when we say we want to construct a cross rate matrix, this is what we want to do, okay? So I'm just trying to compute the cross rate for these relevant currencies. So before we move on to the calculation, let me just show you the final product of the calculation. So essentially, this is what we want to construct, okay? So we want to construct this matrix here. Now, I'll show you later on, but you'll find that if you look at the bottom half of the matrix and the top half, the bottom half will be the reciprocal of the top half. Okay. Oops. Here, here, and here, and here. Okay. So let's go through a few calculations of a few cross rates, and then you can fill in this table later on at home. Okay. Once we understand what we're doing. So first, let me just circle the relevant currencies in this table. So number one, I need my euro. Okay, so the spot rate for the euro is here. Number two, I need my Swiss franc, so it's going to be here. Number three, my Japanese yen, and number four, my pounds. Okay. So I have circled the correct currency exchange rate for my calculation. Okay. In this table, if I look at column 2, this will be the this will be the in USD value. So this is how much a yen is worth in the USD. Okay. So 1 yen equals to this many USD. In my second column, this will be how much a USD is worth in the relevant currency. So here, 1 USD is worth about 109 Japanese yen. Okay. So if you haven't already, make sure you have this table handy before we move on to the next slide. Okay. So in this question, because we are given just the closing price of a currency at the end of the day, so we don't have to worry about the bid and ask rate. Okay. We're going to just use a simple cross rate formula to compute this exchange rate. So if I want to just compute the simple cross rate, I'm going to look at this formula here. Right, so on my left-hand side, I've got my J over K exchange rate. On the right-hand side, I've got these products. Now, because the common currency is the USD, so I replace the USD in my formula here. Okay. So just to recap, when we say J over K, that means we are pricing K in J. So we're looking at the number of J for each K. Similarly here and here. Okay. So let's look at one cross rate calculation. Let's say if I want to find the yen over euro exchange rate, okay? So this is the cross rate that I'm interested in. Now, first step, can someone write the cross rate formula for me for this exchange rate? What do I have on the right-hand side?
$1.
By dollar
USD?
euro by dollar.
Yes, so we're going to divide it by USD. And
Yeah,
then
USD by euro.
USD by euro.
Okay, thanks guys. Exactly right. So this is what our formula looks like. Now, the first exchange rate is the value of the USD in the Japanese yen, right? So this is how much 1 USD is worth in the Japanese yen. So in the previous table, which column would I look at? Do I look at the in USD value or do I look at the per USD value?
Per
Or
USD.
USD value?
Exactly right, spot on. So here I'm looking at a per USD value for the yen. For the second exchange rate, am I looking at per USD or in USD?
In US, In euro?
In USD, yes, exactly. So here I want to find out how many USD is equivalent to 1 euro. Okay. So this one is going to be in USD, and the first one is going to be per USD. Okay. So looking back at the table before, can you tell me the values of these two exchange rates? So how much is this and how much is this? So I'm going to go back to the previous table. So I'm going to need a the per USD value for the yen. So here I'm looking at the per USD column.
109.0.
Exactly right. So 109.03. And for the euro, I'm looking at the in USD value. Okay.
1.1321.
Exactly, spot on. Okay, so we have identified the relevant numbers we need to use. So for our calculation, we're going to have to take this number and times it with the with this number here. Okay. Oopsie, it's not moving. Okay. So here is our calculation. Okay. So we take the per USD value for the yen and we times it by the in USD value for the euro. So this will be my cross rate for the Japanese yen over euro exchange rate. Okay. So what does this number mean? It tells me how much 1 euro is worth in the Japanese yen. Okay. Now, can you help me with the second exchange rate? If I want to find the Japanese yen over pound exchange rate, what would be my answer? So let's take about 2 minutes to do this calculation. Okay.
I just have one question.
Yes.
Why did we multiply Japanese currency to euro currency rather than dividing them?
That's because this is how our formula looks like. Okay.
Yeah. But still, USD would be cancelled out and it should be divided.
Can you repeat the question, please?
I mean that right now we are multiplying Japanese currency with euro currency, right? But if we look at the formula, the USD would be cancelled with USD.
Yeah. So what's the problem with that? I thought that's what we want, right? We want these two to cancel
Yeah,
so that we're left with this exchange rate.
yeah. So we probably would be dividing them rather than multiplying them, I guess.
So
But
what are,
I wanna make one adjustment. Here in this case, we don't have the same dollar value when we compare to Japanese and Europe. So there's a reason we can't eliminate US dollars in two sides.
I don't really understand your question, but let me go back to the first question first. So here I'm multiplying these two rates, right? So I'm not multiplying this number and this number. I'm multiplying these two exchange rates. Okay, so it is not it's not inconsistent.
Actually, Drew was supposed to say that why don't we cancel US dollars from two sides? But I have some adjustment there. Why? Because US dollar in Japanese and US dollar in Europe, when we compare these both, they are not same. So we cannot do that. We cannot do the cancellations. That's the reason we gotta multiply the both.
So you can't cancel them
No,
both?
we can't do that. Why? Because here in this case, US dollars both are different, right, ma'am? When we compare to Japanese yen and euros. So that's the reason we are not able to cancel the US dollars, and we are end up multiplying the both. Japanese 109.03 into 1.1321. After the calculations with USD, we got these both numbers.
So the way I think about it is very simple. So based on the formula I've got, my next task is simply just to find the correct numbers to put in my formula. Okay. So to find these numbers, I'm going to think about what this number means in the table. So this number tells me, for this number, I need to find the value of 1 USD in the Japanese yen. So the next step is for me to go back to the table and reference that number in the table. Okay. Similarly, for the second number, I'm going to look for the euro value in the USD. Okay. So thinking that way, I mean, with that approach, I think it's very straightforward.
Is it like finding out per US dollar in Japan into in US dollar in Europe? Is that easier to understand?
Yeah. So find the
Yes.
US dollar value in Japanese. Yeah.
Right. So the first one should be per US dollar into I mean that is in Japan into in US dollar in Europe. And if you multiply both of them, then you would get 123.4329.
Yeah, exactly.
Got it.
Yeah. Okay. I think how about the calculation that we are currently at?
That is 109.03, if I'm not wrong.
109.03
into 1.4402.
1.4402.
That is 157.025006.
025.
00.
So let's just keep 4 decimal points for just to be consistent with the convention.
Is that right?
Let me check my answer.
I got the same.
Yeah, that's the same for me here. Yeah, so it looks like it's correct, guys. So this number is similar to before. This is just the per USD value in the yen. And the second one is the in USD value for the pound. Okay. Okay. Guys. So if we do the same thing for the pound and the Swiss franc, I think by now we will know what to do, right? So here, if I want to find this exchange rate, what would be my answer? See.
I think that is 0.6944 into 1.0229.
1.0229. 229. And what's the final answer?
That's 0.7103.
7103. Let me check if that's the correct answer. Did anyone else have the same answer with Magana?
Yeah, I did.
You didn't? What did you get?
No, I did, I think. Yeah.
Okay.
But here I think we should take the per US dollar for pound. And then it should be in US dollar for Switzerland.
Exactly, right. Spot on. So let me check. Yeah, that's the correct answer.
Got it.
All right, so if we keep doing the same thing that we did before, for these exchange rates, we are going to be able to find all the cross rates for our relevant currencies. Now, we can do the same thing for the top half of the matrix, but an easier way is just to take the reciprocal, okay? So for example, here, this number here is the value of the Swiss franc in the Japanese yen. So if I want to find the value of the Japanese yen in the Swiss franc, I would just have to take the reciprocal of this number, okay? See. Okay. So have a practice at home. If you like, you can take a picture of this table, or you're gonna have the solutions on Friday anyway. Any questions so far with this calculation? If not, let me move on to the next question, okay? We have about 20 minutes. So let me go through problem A first, and then if we have time, I want to talk about problem 3, okay?
I had just one question.
Yeah, sure.
Are these slides available on the LMS?
No, you will have the solutions, but not these slides. So these are just for the workshop. So if you turn up to class, you've got the slides. If you don't, you don't have the slides.
Right, but as these are recordings, so I can still view them on the recording.
Yeah, sure. Yeah, so they'll be recorded and uploaded.
Yeah, okay, thank you.
So, Professor, is there any chance that we can get these slides from you? Because the slides that are there on the LMS are different from the ones that you are explaining from.
Yeah, so the slides on the LMS will be related to the lecture note, to the chapters that you read. And these slides are firstly the summary slides, and second, the tutorial question slides. So yeah, they are different. But if you go to class, you should be able to get these slides. Okay. So the reason why I don't upload everything is because I want to encourage people to turn up to class. All right, so let me go to problem 8, and then if we have time, we will go through problem 3, okay? So here in problem 8, we've got a bank that have these two quotes, okay? So we have a bid-ask spread for 2 different exchange rates, and we are asked to compute the Australian dollar versus franc exchange rate, okay? So this is a cross-rate calculation that involves bid and ask spread, okay? So let me start a whiteboard, and we can do the question on the whiteboard, okay? So this is what my bank quote is quoting. So the 2 direct quotes are between the Swiss franc and the dollar, and then the Australian dollars versus the US dollars, okay? So I've got my bid and I've got my ask rate. 60 and 70. 1.7225 and 35. Okay. So the question here is, if I want to find the cross rate Australian dollars over Swiss franc, what would that be? Okay, what would be the bid and ask Australian dollar over Swiss franc? Okay. So let's take about 2 minutes applying the same formula that we saw before at the start of the class to work out the bid rate for the Australian dollars over Swiss franc and the ask rate for the same exchange rate. Okay. I'm just going to get some water and I'll come back in 30 seconds. Okay, so let's start with the bit rate. So can someone complete the first formula for me?
I think should be
It would be 1.7225
1.725.
1.7225
into 1 by 1.5970.
Times or divide?
Yeah,
Times 1 over
times
7.
1 by 1.1 by,
Oh, yeah, sorry.
like 1 divided.
Yeah. Sorry.
1.5970.
5970. Okay.
1.078.
1.078. 780.
Yes.
Yeah. It would be 1.0785.
Yeah, A5 or A6. Yeah. I think 5. Correct. So spot on, guys. Now, can you help me complete the formula here, just for completion? So on this formula, what should I write? So here I'm gonna have the Australian dollars, USD, and then USD divided by the Swiss franc. Okay. Are we all good here? Are we all happy with this calculation?
Yeah.
Okay, cool. Now, with the second rate, let me first finish the formula and then you can tell me the answer, okay? So second rate, guys, what are we doing here?
1.7235
1.7235
times 1 over 1.5960.
5960. Okay. And
which is 1.0798.
1.079. Yeah, I've got 99, but it's close enough. Yeah. 99 or 98. Yeah, spot on. So that's the correct answer. So typically these kind of questions will go into your multiple choice questions. And so you're looking at about 2 to 3 minutes for each of these calculations. Okay. Okay. James, are you happy with this question?
Yeah, makes sense now. Thanks.
Okay. Everyone else, are we happy with this question? Shall we move on?
Yep.
Okay. Cool. Thanks, guys. Let me go back to my slide. Okay. So I want to go through problem 3 just because it's interesting and it touches on one of the concepts that we will go back again later on, which is short selling. Okay. So here in problem 3, we've got an exchange, a foreign exchange trader that took a short position of £5 million when the dollar over pound exchange rate was 1.55. Okay. So in this case, this number tells me that £1 is equal to $1.55. Okay. Subsequently, the exchange rate changed to 1.61. So now the pound is a bit more expensive. So I need to pay $1.61 to acquire the same pound. Okay. So the question here is this movement in the exchange rate good from the point of view of the trader? And by how much does the bank's liability change because of the change in the exchange rate? Okay. So this question involves an action called short selling. So here you sell. So when you say short, you're selling an asset that you don't really have. Okay. So when a trader takes a short position, this is when they sell an asset that they don't already own. So essentially, if you want to sell something, that's because you think the future market price is going to drop. Okay. So when you short, let's say you short sell an equity, a stock, that means you sell now and then you deliver the asset later on. Okay. So by taking a short position, it allows you to lock in the current price. So you sell at this current prevailing market price. And then later on, you're going to have to buy back the asset to deliver to your buyer, okay, to your initial buyer. So if you look at the timeline, then when you short, you will sell, let's say, at time 0. And then later on, you're going to buy back the shares. What did I say? So you're going to buy back the financial asset here to use it to deliver to your buyer. Okay. So the implication here is that your profit is going to be depending on how the market moves after you have shorted the financial asset. Okay. So for a short seller, therefore, if the future asset price increases, then you will not be very happy about it. Okay. So you sell here. Let's say I sell a share for $10 today. In the future, I'm going to have to buy back the shares to deliver. So let's say in the future, the share price increases to $12. That means I'm going to have to buy back the shares at a little bit higher price. Okay. So here, by using this strategy, I have made a loss of $2. Okay. So going back to our bank in question, now at the start when I short the pounds, I short the pounds at like at 1.55. Okay, so if I assume that the market rate is going to stay at 1.55, in the future, I mean, yeah. So if the future market price is going to stay at 1.55, when I buy back the pounds for delivery, I'm going to buy back at 1.55, okay? Which means that the cost for this transaction is going to be 7.75 million USD. Now, in reality, the pound has appreciated to 1.61. That means when I buy back the pounds later on for delivery, I'm going to buy back at 8.05 million, okay? Meaning that I have increased the liability by about 300,000. Does that make sense? It's good.
I have a question, Van.
Yeah, sure, Anish.
It's like if he has made a short position at when the rate was 1.55, so he needs to pay at that rate, right? Not on the like the new rate, which is 1.61.
No, so let's say if you short, let's say if you trade shares, for example, so when you short, it's actually the price that you get, that's your selling price. The price that you will buy at is at a later stage, at a later date. Does that make sense? I hope so.
No, I'm still not getting it. Like, for example, if I buy a share, like some stocks from my broker, so I have to pay him at the time of purchase the rate is, right?
Yeah, so if you buy, you're going to be paying at that price. But if
Right.
you short, it's different. So when you short a share, let's say if I short today, right? So if I go to the market and short today,
Yeah.
I'm going to be selling my shares at today's price. Let's say it's $10, okay?
Yeah.
But because I short, I don't have the shares to deliver. So I'm going to have to buy the shares at a future date so that I've got the share to deliver to my buyer, okay? So
Okay.
yeah, so when I short sell, I will be locking in a selling price,
Yeah.
okay? But later on, I'm going to have to deliver the shares, and to be able to deliver the shares, I'm going to have to buy it from somewhere else, okay?
Okay.
Yeah, so this is time, let's say 3 days later,
Mm-hmm.
okay? So here I buy back. Okay, so my profit is going to depend on what is the buyback price. Okay, so ideally for a short seller, I want to see the future price to be lower than $10. Okay, so by the way, on that note, so because of this issue, when you look at the profit function of a short seller,
Yeah.
so when you have a short position, this is your future price, right? So normally, when the future price is lower, your short position, so when the future price is lower, your short position will make profit.
Mm-hmm.
But when it is higher, this is when you make a loss. Okay.
Okay.
Yeah. Yeah, I know it's a bit hard to explain. Yeah. So with short selling, you sell something you don't own yet. So you sell here to lock in a price, and then a few days later, you buy back the shares to deliver, right, to settle the first transaction. So you will make profit if the share price goes down, and you make a loss if the share price goes up.
Okay.
All right. Thanks, Anish. How much time do we have? We have about 3 minutes. So I don't think we have enough time to go through problems 10 and 11. These are complex problems, right? So these are arbitrage problems. Now, I'm going to upload the solutions on Friday, so you can have a look at these questions. But if you want to go through these questions in class, I'm happy to do so next week, okay? So these arbitrage problems are quite complex. So if you want, we can go back and do these questions next week, okay?
Is our class only 2 hours long today, not 3 hours? Or what time do we usually finish at?
Oh, I'm sorry, what time is it now?
4 o'clock?
Oh yeah, I'm sorry, we have another hour.
No, I thought we was off an hour.
Yeah,
That's all
I'm
right.
sorry. Yeah, that's my fault. Okay, guys, so that's good news. That means we can go through these questions in class. Do we want to take a short 5-minute break and when we go back?
Grab a cuppa. Why not?
Okay.
Thanks.
Okay, so let's come back at 5 past and then we can go through the rest of the questions. Okay. Thanks for letting me know, James.
Yeah, no worries.
Okay, so before we continue, let me just point you to the practice midterm exam folder in your LMS. So I have made this folder available, and in this folder, you will see the relevant information for your midterm exam. Now, this is just a practice, right? So this is not going to be marked. And at the moment, as of today, I haven't made this available yet, but I think it's going to be available by Friday this week. So the purpose of this practice midterm exam is for you to revise, to prepare for your actual midterm, which is in week 6, okay? This table here will tell you all the information that is in your midterm. So basically, you're going to have 2 parts. The first part is going to be a multiple choice section with 15 questions. And the second part is a calculation question, okay? The relevant topic is from week 1 to week 5, okay? Yeah, I'll make it available by Friday, so you will see what to expect in your actual midterm, okay? This practice midterm is open until the day before the actual midterm, and you can practice as many times as you like, okay? Let me close this first. Your assignment is going to be available sometime next week, probably next Friday. I haven't finished writing it yet, but the case will be on Afterpay, okay? So if you want, you can go and have a look at Afterpay, find some background information first, and I'll upload the case next week, okay? Yes.
Professor, I'm sorry, but is this practice midterm going to be marked?
No, it's not going to be marked.
Then what is those 10% like online marks for?
That will be for your quizzes. So we will have some quick weekly quizzes. So I will announce, let's say in week 5, let's say if I want to have a quiz, I'll announce it on Monday and you will have the quiz on Friday, okay? So that will be different from the practice midterm exam.
Okay, so even the revision quizzes are not going to be marked, right?
No. The revision quiz is also for practice.
So whatever which is going to be marked is not yet, shown to us.
No. So I will let you know which one is accessible. Yeah. So when there is an accessible quiz, I'll make an announcement on Monday. Okay. All right. So as I said before, the case is going to be written on Afterpay, which is a pay now. What is the term?
Buy now.
Buy now. Yeah, exactly. Sorry. Buy now, pay later. So if you want, you can have a look at this company and then, yeah, just to prepare.
Quizzes would be in-class quizzes, or it would be like a portal on which we have to go and just give the quizzes.
Yeah, it's just online. It's going to be scheduled on Friday.
Okay.
Yeah. So half an hour on Friday.
Thank you.
All right, let me go back to my screen. Here we go. All right, so sorry guys, I think I was rushing a little bit at the start because I thought we ran out of time, but we have a whole other hour to go through the questions. So let me talk about question 9. So here in question 9, we are once again asked to compute a cross rate, okay? In this case, we're given the American terms and the European terms for exchange rate quotation. And the 2 currencies we're looking at are the New Zealand dollar and the Singaporean dollar. Okay, so this is New Zealand dollar and this is Singaporean dollar. So the question asks us to compute the bid and ask quote for the New Zealand over Singaporean dollar exchange rate based on the information we have here. Okay. So here I need a bid rate and I need an ask rate. Okay. So we have done this before. So can we spend about 2 minutes on this exercise and let me know the answer? Okay. Okay, what is the answer?
I got SB equals 1.1832.
1.1832 for the first one?
Yeah, for B. Yeah.
1.1832.
Oh,
And can you tell me the second one?
oh, sorry, I think I'm confused now. One sec.
Yeah, sure. Yeah, I think that's the other one. That's the reciprocal.
Yeah, I think I got them backwards, right?
Yeah, that's the reciprocal.
Yeah.
That's the bit rate reciprocal. Let me erase it first.
So it's 0.8436.
Exactly, spot on. So the first rate is 0.8436. Did everyone else have the same answer?
Yes.
Yep. Thank you. What about the ask rate?
That's 1.854.
I think you got it the other way.
Now. Yeah.
Yeah. It should be 0.84 something.
Oh, 0.8452.
Exactly, right. So this is correct. Yeah, so normally the bid and ask rates tend to be quite close together.
Right, okay.
Yeah, and if you want to find the reciprocal, if you take the reciprocal of this rate, you're going to have the ask rate for the other exchange rate. Okay, so that would be 1.1854. This is going to be the ask rate for Singapore dollar divided by New Zealand. Okay. One thing to also look out for is, say if you're in an exam environment, So normally the bit rate should be lower than the ask rate. Okay. So for example, here, the bit rate is a bit smaller than the ask rate. Okay. And they tend to be, yes, did someone say something?
Sorry to interrupt you. Could you just let me know the exact digits which come under the NZD by USD? I just want to confirm if I was written correctly, because I went somewhere wrong, so I just want to confirm it.
The exact digits?
Yeah, I mean the substitution of the.
Oh, okay. So you want to know these numbers?
Yeah, I mean just the first one. I kind of went wrong somewhere. I just want to confirm it.
Okay, sure. So with this one, it will be the bit rate for the per USD for New Zealand. So that will be here. So 1.3751. This one is the in USD bit rate for the Singaporean dollar. So we're looking at here in USD bit rate. Okay.
Thank you so much.
Okay. Moving on to problem 10. Now, this is a bit more complex, right? And if this is the first time you do some sort of arbitrage calculation, it's going to be a bit more confusing, okay? Has anyone done derivatives before?
Yeah.
Yeah? Okay. That's good then. Yeah. So these will be quite familiar for you.
It's still hard.
Yeah.
Yeah.
Yeah, a little bit easier. So in this case, we have a cross-rate arbitrage question. So before we go on to the calculation, let me just briefly talk about what is cross-rate arbitrage. Okay. So cross-rate arbitrage or triangular arbitrage is when you have three currencies involved. Okay. So similar to any arbitrage strategy, the first step is you want to identify a mispricing. Okay. And in this case, as the name suggests, the mispricing opportunity comes from a mispricing in the cross rate. Okay. So your strategy starts with the cross rate calculation. Then based on the mispricing calculation that you did before, you will then trade three different currencies. Okay, so your triangular arbitrage should include three transactions, three currency conversion. So you want to trade out of one currency into another currency, and then from that currency to a third currency. And finally, you want to close the loop, right? So your final transaction should be converting back into the first currency. Okay. So let me give you an example. Let's say I've got three different currencies, the AUD, the USD, and the pounds. Okay. So with a triangular arbitrage strategy, you should have three currency transactions. Okay. So let's say I start with the AUD first. So I might convert into the USD in the first step, then from the USD to the pounds, and then finally back to the AUD. Okay, so your final transaction should be converting back into your first currency. Okay. So in this example, if this is how I construct my arbitrage strategy, then my profit should be denominated in the AUD, okay, in the currency that I start with. Okay. So having talked about a brief idea of what arbitrage, what cross-rate arbitrage is, let's look at an example. Okay. So in this case, I've got three currencies. I've got the Swiss franc, the Australian dollars, and the USD. Okay. Now let's suppose this is from CBA. So I observe this rate from CBA. This is from ANZ, and this is from NAB. Okay. So each of them specialize in a different currency. So based on the quotes in the question, ignore transaction costs. Do we have an arbitrage opportunity? And if there is any, how do we take advantage of it, right? Suppose that we start with $1 million USD, okay? So for a cross-rate arbitrage calculation, the first thing you want to do is you want to check for mispricing, okay? So let's suppose we have three different currencies here, and potentially we can choose any kind of currency we want. Suppose, let's say I want to compute the cross rate between the Australian dollars and the Swiss franc based on the first two quotes, okay? So let's do this calculation first, and I'll explain to you why we want to check the cross rate later, okay? So based on the first two exchange rates, can you help me compute the Australian dollar over Swiss franc exchange rate? Okay. Let me write USD here. So from these two rates guides, I want to find the AUD over Swiss franc cross rate. Okay. Can you help me with this exercise?
Sorry, what do you mean by cross rate? The bid and ask?
No, it's the Australian over Swiss franc exchange rate.
That's 1.1405.
So this is the rate given by another bank, right?
Times 1 over 1.5971.
I'm sorry, what did you say before?
This price times 1 over 1.5971.
Okay, so you're trying to do a cost rate calculation. Let me answer James' questions first. So what do I mean by a cross rate? So let's suppose we observe these two rates, right? So these are between the Swiss franc and the dollar, and the Australian dollar and the USD, okay? So based on these two rates, I want to find the Australian over Swiss franc exchange rate.
Right.
So
essentially to prove that it is 1.144.
Exactly, spot on. Yeah. So that's why I want to compute this rate.
Yeah.
So so did someone give me the answer before? I'm sorry.
Yeah, I did the same price.
Yeah. It's the same price. That's a bit surprising. Hang on, let me start the whiteboard. So based on the information in the question, now I'm just looking at the first two quotes, okay? So here, I don't get the same price though. I don't get the same quote. So if I do this calculation here, I'm going to get 1.1405. Okay.
That's correct.
Yeah. So if I compare this to the rate that we see in the question, are they the same?
Not quite.
Not quite, right. So this is a bit lower than the other rate. Okay. So what does it tell me here? Can someone please turn off the notification? I'm sorry, it's a bit distracting. All right, so we just did this calculation before. So we computed the cross rate Australian over Swiss franc for the first two quotes, right? And we find that the cross rate was 1.1405. So if we compare that with the rate that we observe in the last row, we will see that it's a little bit different, okay? So it looks like the Swiss franc is priced a little bit differently in two different places, okay? So the Swiss franc, oh, by the way, this number means that this is how much a Swiss franc is worth in the Australian dollars, okay? So it looks to me that NAB is currently pricing the Swiss franc at 1.144, whereas for CBA and ANZ, they only value the Swiss franc at 1.1405, okay? So do you see why we need to do the cross rate calculation now? That's because we want to find if there is any mispricing, okay? So I'm just going to write that down on the whiteboard. So here with ANZ and CBA, they are currently pricing 1 Swiss franc at 1.1405 Australian dollars. Whereas for the other bank, which is NAB, they trade 1 Swiss franc at 1.1440 Australian dollars. Okay. So we have detected that a single asset, an identical asset, is traded at two different prices in two different places. Okay. So given this mispricing, what do we want to do?
Can short sell NAB Australian dollar over Swiss franc and buy in ANZ Bank.
Exactly right, spot on. So I want to sell here and I want to buy here, okay? So that I earn a spread of 35 basis points between the two. So here I want to be selling, let me write it down properly. So I want to be selling the franc at 1.1440 Australian dollars to NAB. And I want to be buying the franc at 1.1405 Australian dollars indirectly, right? So this is not a direct transaction because you have to go through two banks, okay? Through transacting with ANZ and CBA. Okay. So by doing so, I'm going to earn a spread in between. Okay. So from the analysis before, we have identify what we should do, right? So we should buy somewhere and we should sell somewhere, okay? So our next step is to write down the relevant transactions. So we mentioned before, we want to buy at 1.1405. And I want to sell at 1.1400. Sorry, 1.1440. Okay. So with the buy transaction, because this is through a cross rate, I'm going to have to execute this transaction through the first two banks. Okay. So in other words, I'm going to be selling the AUD for USD to the second bank, and then I'm going to be selling the USD for the franc from the first bank. Okay. Does that make sense? Do we see why for the first transaction, for the buy transaction, we want to do these two steps? So here, this is my transaction, okay? So I've got the AUD and the franc. What I want to do here is I want to buy the franc, okay? So in an exchange conversion, when I buy the franc, I'm going to acquire the franc and I'm going to pay the AUD, okay? So here I'm going to pay the AUD and I'm going to acquire the franc. So if I want to do that indirectly through the USD, then what I'm doing here is I'm going to sell the AUD to acquire the USD, okay, in the first transaction. And then once I've got the USD, I'm going to sell the USD to acquire the franc, okay, in my second transaction. So through these two transactions, effectively, I have canceled out my USD holdings. So this indirect transaction is equivalent to selling the AUD to buy the franc. Okay. Are we okay here? Okay. If that's okay, let me move on to the next slide. Okay. So we have identified the transactions that are involved in this strategy, which is to sell the AUD for USD at the given rate, then to use that USD to buy the franc, once again at the given rate in the question, and finally to sell the franc for AUD in the market to the last bank. Okay. So what I'm going to do next is, depending on what the question asked me to start with, say for example, in this question, we start with the USD. Then based on this starting point, I'm going to rearrange my transaction, okay? So if I start with 1 million USD, I'm going to use that USD to acquire another currency, okay? So here the order of my transactions will look like this. First, I'm going to use the USD to buy the franc. So I'm going to rearrange the first transaction here. Second, once I've got the franc, I'm going to sell the franc to buy the AUD, okay? So that means I'll rearrange this transaction to here. And finally, from the AUD I have acquired in the second step, I'm going to use that to buy the USD at the last step, okay? Which means I'll rearrange this transaction to here. So as we mentioned before, you want to close the loop. So you start with the USD, you convert it into the franc. Then from the franc, you convert it into the AUD. And finally, you convert your AUD back into the USD, okay? So you have closed the loop now. So to compute the profit of this strategy, I'm going to take the final product, so the final outcome, which is 1.003 million USD. And I'm going to deduct that with the initial starting point, okay? So my profit, therefore, is going to be this ending point minus 1 million. So that will give me 3,064.73 USD, okay? So in an arbitrage strategy, you want to check 3 things. Number 1, you should not be, you should have a zero cost strategy. So for example, in this strategy here, in the first transaction, you acquire the franc, right? And then you sell it in the second transaction. So these two cancel each other out. Then you acquire the AUD in the second transaction. You once again offset it in the last transaction. Also, with your last step here, you acquire the USD, which you can use to offset whatever you invested at the start, okay? So it does not require any initial investment. Second, this is a zero risk strategy, right? So in the end, you do not hold any foreign currency, okay? So in the end, your position in the Swiss franc is 0. Your position in the AUD is also 0, okay? So no exposure to foreign exchange rate risk. And finally, you should have a positive profit in the currency that you start with, okay? Okay, is that clear? Is this exercise clear? Okay.
Yeah.
Thanks, James. So with this arbitrage calculation is not too complex after you practice it for a while. I think the hardest thing with this calculation is just the first step, which is to compute the cross rate. Once you're on top of that, everything else would just be currency conversion calculation, okay? Now, one point to note is that doesn't matter which currency you start with, if you set up your strategy right, you should still end up with a profit, okay? So in your own time, I want you to practice this question again, but changing from the USD to the other 2 currencies, okay? So if you start with the AUD, how would you set up your strategy, okay? Similarly, if you start with the franc, how would you set up your strategy? Okay. So this is the answer. If you are interested, you can take a snapshot of the slide. So that's for the AUD. And then if you look at the franc, this will be the steps, okay? But once again, so we should end up with a profit regardless. Okay, what is this here? So in this case, the question is similar to before. I mean, the problem is similar to before. The only thing that is different is the way the question is framed, okay? So here you've got a trader with Deutsche Bank, and from their screen, they can see the prices of another 3 banks, okay? So here they are trading the euro, the dollar, and the Swiss franc. Suppose, based on the information that you have from the screen, suppose you want to do a triangular arbitrage, show how you can do that with 5 million USD. Okay. Second question, what happens if you initially sell the dollars for the Swiss franc? So essentially this question is saying if you change your strategy around, if you reverse the direction of your strategy, what do you see? Okay. And finally, what euro Swiss franc price would eliminate triangular arbitrage? Okay. So let's go through the first part of the question together. Let me summarize the information on the whiteboard for you. Okay. So here you're a trader and you observe on the screen. So the first one is Dresdner Bank. It must be a German bank. I'm just going to say DB. So here they trade the euro and the dollar. So 1 USD is equal to 0.7627 euro. Okay. Credit Suisse. So here 1 USD is going to be traded for 1.1806 Swiss franc. Okay. Finally, UBS. So for UBS, 1 Swiss franc is going to be equal to 0.6395 euro. Okay. So first question, triangular arbitrage. So following the same steps that we did before, can you first help me compute the cross rate euro over Swiss franc from the first two quotes? Okay.
$1.5487.
1.5487.
Yep.
I've got a little bit different answer. So did you take the reciprocal? So I've got 0.6460.
Reciprocal.
Yeah, I think you got the reciprocal. So here I need the euro over USD times USD over Swiss franc. Okay. So this is the value of 1 USD in the euro, so that's 0.7627. This is the reciprocal of this. So that will give me 0.6460. Okay. Did everyone get the same answer?
Yeah.
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 Yeah. Okay. So we have done the first part, which is to compute the cross rate. Okay. So based on my calculation of the cross rate and the information from UBS, can you tell me how can I set up my arbitrage strategy? So I want to find out where I will buy and where I will sell the franc. Okay. So comparing these two different rates, can you tell me which rates you want to buy and which rates you want to sell?
So you want to buy at 0.63 and you want to sell at 0.64?
Exactly right. So you want to buy at 0.6395 euro and you want to sell at 0.6460 euro. Okay. Spot on, guys. So we have identified the first step, which is where to buy and where to sell. Okay. Now, for the buy transaction is quite straightforward. I'm just going to go to UBS and trade with them directly. Okay. So UBS allows me to exchange the euro for the franc directly. For the sell transaction, because it involves a cross rate, I'm going to have to go through Deutsche Bank, Dresdner Bank and Credit Suisse, okay, which are the first two banks. So with the sale transactions, can you tell me what are the steps involved? I need two transactions here because it's an indirect transaction. So with this transaction, I'm selling the franc and I'm acquiring the euro. Okay.
I believe you should be selling euro and then buying franc in the other bank and then again selling Australia.
You mean the USD?
USD, sorry, USD.
Yeah.
At the end.
I'm just looking at the sell transaction here and I want to decompose them into two, right? So here with this transaction, I'm trying to sell the franc and I'm acquiring the euro in the process, okay? So with my two mini transactions, I need one where I sell the franc and then the other one where I buy the euro. Okay.
Would you explain which one should we sell and which one should we buy?
Yeah, so that will depend on what you want to do with the franc here. So here we say that we want to sell the franc at this rate, right? For the at how much euro here. So based on this information, so if I want to sell the franc, then in my indirect transactions here, it should involve selling the franc at one bank. And then because for this transaction, I'm going to acquire the euro in the process. So my second transaction will be to buy the euro. Okay, does that make sense? So these two transactions should be consistent with what you do over here.
Sure.
So let me explain it first, and then we can go back here later on. So in the first transaction, I'm going to be selling the franc for the USD. right? Because that's what Credit Suisse is doing. So they're trading the franc for the USD. In the second transaction, I'll be buying the euro using the USD. Okay. So, in other words, I'll be trading with Dresdner Bank, okay, who trades euro and USD. So, in the first transaction, if I trade with Credit Suisse, I'll be trading at 1.1806. Okay. I'm talking about the franc, isn't it? So here I'll be trading at the reciprocal. In the second transaction, I'm buying the euro. So here, 1 euro is worth 1 divided by 0.7627 USD. Okay. So essentially, let me explain this again. So in this transaction, I want to be selling the franc and acquiring the euro. Okay. So this is what I want, and I'm going to set this up through the USD. So if I want to sell the franc, I'm going to be selling the franc to acquire the USD in the first step, which is what I do here. In the second step, I'm going to use the USD I just acquired to buy the euro. Okay. So essentially, through these two steps, I have canceled out my USD holdings, and what I am left with are the two positions in the franc and the euro. Okay, which is consistent with what I want to do here. Yeah, it's going to be confusing for a little while, but if you practice a few times, it should be okay. It's just a procedure. If you follow the procedure, it should be okay. So once I have identified the relevant transactions for my strategy, right? So these are all the transactions I'm going to do. The next step is I'm going to rearrange these transactions to fit with the starting point in the question. Okay. So the question asked me to start with 5 billion USD. And therefore, in my first transaction, I'm going to use the USD to acquire another currency. Okay. So in my first transaction, I'm looking for a transaction where I use the USD to acquire another currency. Okay. So here I'm going to use the USD to buy the euro at the exchange rate given in the question. So I think this is from Dresdner Bank. Okay, so that's the first bank. So in the first transaction, I have sold the USD to buy the euro. Okay. In my second transaction, I'm going to use that euro to acquire the franc. Okay. So here I'm offloading my euro to acquire the franc. So looking back on my left-hand side, this is the transaction that I want. Okay. So once I've got the franc from the second step, I'm going to use it to buy the USD to close the loop. Okay. So here I'm using the franc to buy the USD. And that will be my last transaction here. So going through these transactions, I have ended up with a dollar figure. Okay, so this is the same currency as with what I started with. So to compute the profit, I'm going to take my final outcome, which is 5,000,051, and I'm going to minus that with the initial starting point, 5 million. So my profit is about 51,000 USD. Okay. So does that make sense, guys? Moving from step 3 to step 4. So from step 3, what we did was we try to identify all the transactions involved. And then in step 4, we rearrange these transactions to fit with whatever we start with. Okay. So here, if I start with the USD, I know that my first transaction should involve selling the USD. Okay. So I want to offload the USD that I have. So with an arbitrage, a triangular arbitrage question, you should have 3 transactions. So by the time that you finish the third transaction, you should end up with the same currency that you start with. Okay, so closing the loop. How do we feel now? Are we confused yet? Okay, how much time do I have? I have about 3 minutes. So I know it's a little bit complex for now, but if you practice a few times at home, you will see the logic behind it. All right. So in the next question, the question asks what happens if you initially sell the dollar for the Swiss franc. Okay. So to answer this question, you will need to work out the steps involved first. Okay. So for that question, you will need to be able to do step 3 first. So the question says, what happens if you sell the dollars for the Swiss franc? So in our arbitrage strategy, for the transaction that involves the Swiss franc and the dollar, what we want to do is we want to buy the dollar for using the Swiss franc. All right. The question suggests us to do the opposite, which is to sell the dollar to acquire the Swiss franc. Okay. So essentially, you want to reverse the direction of your arbitrage strategy. So the answer is obviously if you reverse the direction of the arbitrage strategy, you're going to be buy high and sell low. Okay. So with your arbitrage strategy, you buy low and you sell high. So when you reverse that order, you're going to be buying high and selling low. So you would expect a loss if you do so. Okay. So more formally, if you want to rearrange the equation, the transactions, starting with selling the dollar for the franc, as the question suggested, then this is what you would end up with. Okay. So in this case, you will end up with a figure that is smaller than 5 million. And so you're making a loss here. Okay. Final question, what exchange rate, euro over Swiss franc exchange rate, would eliminate triangular arbitrage? So the short answer is the cross rate between the euro and the Swiss franc should be the same as the direct quote from UBS, right? for no arbitrage to happen. Now, because we run out of time, I think I'll revisit this question next week when we come back, okay? So I want to spend a bit of time on this question as well to make sure we understand triangular arbitrage, okay? Any last minute questions before we conclude?
I just have a question, Van.
Yeah, Anish?
That on this coming Friday, the first quiz is going to get opened, right?
You mean which quiz? The accessible quiz or?
Yeah, accessible, yeah.
No, not this Friday. So what I mentioned before was the practice midterm exam.
Okay.
So yeah, so it's just for practice. Yeah.
Okay, but on the LMS, it's showing that the first quiz is going to get open on 5th of August and it's going to close on 24th of August.
Yeah, so that refers to the practice midterm, I think. It's the practice one, yeah.
It is mentioned as practice midterm A, part A.
Yeah, so this is midterm.
Okay.
Yeah, correct. So that will be just the practice. So this is not accessible and this is something you don't have to do. It's just there for your revision, okay? Does that make sense, Anish?
Okay.
Yeah, so this is not accessible.
Yeah, I'll just have a quick look, sorry. Yeah.
Yeah, so it will be open tomorrow then. Sorry, I thought it was Friday.
Practice. Yeah, that's right.
Yeah,
Sorry.
so it's not graded. It's for you to revise for your midterm. Okay, guys. I think
Thanks.
All right,
that
thank
is
you.
all for today.
See you, Anna.
Thanks, guys. I'll see you next week. Okay.
Thank you. See ya.
See ya.
Bye-bye.